Akpaida, as earlier introduced. I am the financial inclusion lead at the 9 Payment Service Bank here in Nigeria, and I will be the moderator of this panel. Talking about how to bank the unbanked population is one of my favorite things to talk about. And today we have seasoned experts in banking, in cybersecurity, mobile financial technology, digital lending, and the likes, who will be sharing their insights on the strategies to bank the unbanked and basically touch on the challenges in banking the unbanked. As we know, financial exclusion is a huge challenge, as identified by the World Bank. And in African continent especially, we've seen quite a lot of innovation, with Fintechs, but yet it's not really translating into banking the unbanked population, and that's what we'll be delving into. So are all my panelists ready? You have already been introduced, so I will be starting my questions now. For the participants and attendees, please put in your question at the Q&A session of the platform, and then we'll be able to pick your questions after the panelists have made their presentation. All right, so I'll be starting with Abdi. In the last 5 years, there has been a massive growth in fintech innovation, and we have seen the advent of unicorn companies like Flutterwave and InterSwitch in Nigeria. We've also seen unicorn companies like Fori in Egypt. Can you please share your insights on how these innovations have encouraged financial inclusion in our continent? Thank you very much.
Thank you, Onyeka, and thank you, team. I'm looking forward to this discussion. It's great to be here. I think when you look at financial inclusion as a whole, there is, of course, the wider economic picture of Africa, where you find that, even when you look at private sector lending to the whole economy, Africa is still in the 20s, 30% of GDP. You go to some of the developed world, it's at 100+% of GDP. So there is a wider developmental issue that impacts the level of inclusion. But I think back to your question in terms of innovation and what it has done over the last, especially 10 years or so, with regards to mobile technology, with regards to what the Fintechs are doing, it improves one pillar of inclusion, which is the pillar of access. With inclusion, you're talking about the product itself, you're talking about functionality, but there is also access and availability. And while in the past, it has been mainly driven through brick and mortar banking type of presence or agencies and that type of thing, the Fintechs have really taken it to a new level and have increased the level of access in Africa. It has also increased, the adoption level, which in some countries has been revolutionary, to be honest, especially on the payment side. At one point, a few years ago, that picture has changed now, but 5-6 years back, 1 out of every 2 users of mobile money was, and therefore, that's a big step, but we still have a long way to go, I would say, Onyeka.
Okay, thank you. Okay, thank you very much, sir. So the next question will be for Brian. Hello, Brian. Good morning.
Morning.
I know what you're doing. You're doing a really great job with WIZZIT, and you're well versed in building mobile payment solutions for businesses. How can we drive digital inclusion for micro enterprises in the informal sector?
Thanks, Onyeka, and good morning to everybody. At the risk of being controversial, because it gets everybody to think, I don't really mean to upset anybody, but really just to try and engage everybody and get everybody thinking. As Abdi has said, the topic of financial inclusion has been around for many, many years. We're proud to be pioneers in this space since 2004, but there's still an enormous amount of work to be done in this area. And without trying to teach anybody to suck eggs, the whole topic of financial inclusion really rests on 2 pillars: the issuing side, signing up people who previously have not been banked, and the acquiring side, giving them a place where they can spend and utilize their newfound digital currency. And I think the focus of everybody up until now really has been on the issuing side, and certainly we are very much part of that, operating across 4 continents. But the major opportunity lies in the acquiring. And part of the unbanked problem lies with the SMMEs. Everybody will nod their head, and I hope you all will, that the small business enterprise is the backbone of every economy. Speaking to a multi-billionaire business leader, he says he doesn't know of a single big business that didn't start out as a small business. And I think there's an element of truth in that. Yet I would think, and most people would agree, that big banks typically are not geared to handle the issues of the small and micro merchant. It really has not been on their landscape. And I come back to something I've been preaching since 2004. Should and can a bank be everything to everybody? And I keep beating that same drum, that it's all well and good to take out a stick and say banks, 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 banks. But I really do believe that the time has come that we've got to open up the space. We've got products that are designed in the 18th century that are meant to be assist people in today's worlds. Banks do not provide anything useful to the unbanked. And I bring into that the small and micro merchants. We've got a situation where some of the banked, most of the underbanked and all of the unbanked are turning to alternative providers because banks cannot or will not deliver services that their customers want. In the United States, supposedly a developed market, there are 67 million people that do not make use of formal financial services. That represents 25% of all households. Yet this is the frightening statistic, ladies and gentlemen. That 67 million strong body pays $189 billion, not million, billion dollars in fees to alternate suppliers. So it brings me back to the question that should we keep beating up the banks? Because I don't think that we necessarily should. But 189 billion to alternative suppliers of financial services that are not your traditional mainstream banks. And I want to emphasize that this is not illegal or illicit functions. This is for payments of goods and services that people are looking for alternatives. So getting back to the question that you asked, Onyeka, we need to start focusing, I believe, on the small merchant. And today, every merchant has got a cell phone. Why can we not utilize the same cell phone as the acquiring device, that I can go there, I can purchase my goods and services, tap on my device, and it's done. And I have the added security of the one thing that is universally accepted everywhere in the world and trusted, and that being the PIN. And I do believe that for any form of contactless payment, we do need a PIN. Merchants are screaming for it. There are 2 little entities, coffee shops, in the vicinity of my office. As you walk in, there is a big sign. We do not accept cash. And that, whether we like it or whether we don't like it, is going to happen more and more. I just want to end by saying perhaps that the whole focus of what we are talking about is to move away from this very large statement about banking the unbanked. And maybe that is not the problem, and maybe banks should not be providing the solution. The issue is not about that. It's about serving the underserved. And the crucial utility that should be provided is not banking, but I believe it's in payments and providing a safe, secure way to facilitate that particular role. And that bank accounts are inexpensive and an inflexible way of solving the problem of the underserved. Let the banks focus on the important role of lending and providing credit, and let others get involved in the area of payments. And that specifically is around the small and medium-sized businesses.
Thank you very much, Brian, for that very passionate insight. So I'll just segue from what you have said and go straight to Anna. You talked about providing secure platforms for payment. Now, Anna, part of the reasons why I believe there's a slow uptake of digital financial services, especially in developing countries where you have cash as the order of the day, is a lack of trust. Can you highlight some of the cybersecurity challenges faced by fintechs in driving digital financial services? And it's a 2-part question. And can you also tell us how fintechs can adequately communicate cybersecurity measures that have been put in place to protect customers from scammers and to instill trust in the platforms that they have provided. Thank you very much.
Yeah, thank you. Thanks, Brian and Abdi. I really enjoyed your contributions just now. It's really interesting. And I'd like to, before I dive into the security side and the trust things, I would like to just mention that, because you can hear by my accent, I'm actually from Germany, but I've lived in South Africa for about 20 years. And what I find interesting is when I get visitors from overseas, how amazed they are by the mobile payment platforms that we have in South Africa. I think Brian mentioned it. It's the same for me. I can't remember when last did I have to draw cash. I mean, everything is done via SnapScan or Zapper or whatever the mobile payment applications are. And I mean, now with Apple Pay, I think the developed countries are more sort of on par, but we've been doing this in South Africa at least for many years. So I think that Africa really has an opportunity and is like an early adopter when it comes to anything mobile and mobile financial services and payment related things. So that's just by the by. However, in terms of the trust side, I know that in European countries there is a very deep ingrained appreciation for privacy, particularly in Germany, again, where I can, they've had data protection regulations since the 80s. People are very concerned about their identity and their personal information. They also, by the way, this is again a cultural thing. They're very cash heavy, like they haven't really embraced credit cards even. It's quite, from a cultural point of view, is very different. So whereas in Africa, I mean, our personal information data protection regulations are very, very new, if at all. I mean, we have I mentioned it early on, the African Union Data Protection Convention, also called the Malabo Convention. It's a great piece of regulation, but it has only been ratified in 19 of the countries so far. But slowly, more and more, South Africa has just sort of enacted our POPI Act. Obviously, Kenya and Nigeria have their versions of data protection. So it is becoming more of a, I think, mainstream awareness that privacy and personal information is something that providers have to protect, and consumers are becoming more aware of it. Unfortunately, the general level of awareness amongst the consumers and the small business owners, by the way, also as well, not just the small, even the bigger ones, the awareness in terms of the threat landscape and what's possible in terms of compromise, what's possible in terms of the actual risks and the impact is still very low. And I don't know if a few of you saw my talk earlier on, but we do the survey once a year across 8 African countries, and actually speaking to the consumers about their understanding of cybersecurity, cyber risk, their mobile sort of, in terms of using mobile applications and their privacy. And there is a real misunderstanding or non-understanding of the threats out there. And unfortunately, with America and the developing nations clamping down on cyber criminal gangs, like Biden recently declared that ransomware is a national threat, the criminals are going to shift their attention more towards the emerging economies, because they know we don't have the force to come after them. We don't have the regulations to come after them like they may have in the States or in Europe, even though they struggle as well, by the way. So it's but I think what we've seen is really a shift in terms of the criminals really looking at Africa as an interesting market. Like if you go back 10 years ago, you wouldn't find anything in the dark web about South Africa or African countries. Now there's lots of mentioning of data being sold on there, of attacks against organizations in our region. So the call really to I think the banks or the financial institutions, they've been more early adopters in terms of security controls. Even before their countries may have had data protection regulations, they know they have to protect their customers' data, at least the reputable ones. But the new market entrants, the fintechs, etc., it's really important that they keep in mind the threats and that they are in the firing line, that it is all about the money and information is money, and that when they go out in this race to market, that they don't neglect the security side in their development life cycle. And obviously they also have, I feel, all of us have a responsibility to do more public-private collaboration, to work with the governments, with the telcos, with the banks, with the fintechs, and help with the consumer education. And when you offer a app, when you offer a payment solution or whatever it is, maybe throw in a little bit of education as well, because the literacy problem and the digital literacy problem is something that we are faced with on the continent and that we have to address.
Okay, thank you very much, Anna. So my next question is for Martina, who actually happens to be my boss. Hi, Martina.
Good morning, Onyeka.
Good morning.
Okay, you're at work. You're at work. That's good.
So the Central Bank of Nigeria approved payment service bank licenses, with a mandate to have 25% of its business in rural areas. We would say, PSBs are supposed to be, the champions of the underbanked or the unbanked, So my question is this: how can PSBs guarantee adoption of financial services by the people at the bottom of the pyramid, bearing in mind you have, multiple automated channels, and many of these people, digital inclusion is equally low, in that demographic?
Thank you very much, Onyeka, and good morning once again, everyone on the panel and in the audience. It's a great pleasure to be here. So indeed, as you mentioned, 9PSB has entered the market sometime last year, in the second half of last year, and I think you can all imagine what it means to enter into this industry after years and we can say even decade of different initiatives that have tried to put Nigeria on trajectory to have as much population as financially included as possible. And as I mentioned even earlier, we are not there yet. So obviously we need to adopt a different strategy, different models, be a little bit creative, and just on to build on Brian's submission, it's actually really a matter of collaboration between various sectors, and I much rather also like to call this process serving the unserved than only banking the unbanked, because it really cuts across different sectors. So it's not just providing a digital app, because obviously if it is a digital already, then the bottom of the pyramid and financially excluded people are not going to even have access to that. But it's rather a set of different various factors that we at 9PSB are putting in place as part of our strategy to ensure that long-term we have a sustainable model for financial inclusion in Nigeria. So first one being a scalable business model. Obviously, that lack of infrastructure or infrastructure gap, which is the primary reason for such a high rate of financial exclusion, is something that we are addressing through our partner agent network, but more importantly through partner network of strategic partners that are serving as hubs in various areas. In that way, we are able to ensure scalability and fast go-to-market nationwide, which if we would go directly to each and every agent location or customer location would be impossible to do from the centralized point. That leads me to another point. The second point, which is that we believe that financial inclusion needs to happen on multiple levels, not just on the customer level, and we are talking about banking the unbanked and serving the unserved, but rather as Brian and Anna mentioned as well, on the SME level, on the informal sector, that is not just customers, but businesses that are financially excluded. We need to bring them into the system that will again serve them as hubs and cascade that idea and the system of financial inclusion to the customers that they serve in their areas. That also actually has a dual purpose, which is as well building the trust. I mean, all of us here, we can talk about financial inclusion on this platform, on the online platform, some of us even from other countries that are working on these kinds of projects in Nigeria or in other countries in Africa. But people, and especially people who are on the bottom of the pyramid, as you said, financially excluded, will trust their neighbors, their local leaders and chiefs, and that is what we are trying to leverage on in our go-to-market strategy. The third point is also, and that is maybe one of the main reasons, along with lack of accessibility, lack of infrastructure, one of the main reasons why the financial inclusion rate is still quite low is basically lack of relevant products. Again, we are talking about various digital and fancy and exciting apps built by Fintechs, serving various purposes, which are great. But most of them, or a lot of them, with notable exceptions, speak to the already banked people and the bank population. So that is something, you know, that I also addressed a bit earlier. We need to, as the industry, address and try to resolve, and with partnering with different fintech companies and developers, we are in 9PSB trying to provide those relevant services and products to the unbanked, something that will actually help them and bring them a real value to their life. And having all of that in place, then one of the crucial things also is, and I think Anna mentioned that, is the financial literacy and trainings that need to happen, again, not necessarily from centralized place and you know, one size fits all, but rather through various, let me call it, distribution levels of financial inclusion systems that we are putting in place. Thank you
very much. Thank you very much, Martina. Brian, you can go ahead, please.
Yeah, just a real live practical example of collaboration. We're working in Central America with a country that has launched a social grant and social welfare payments around the COVID pandemic. And here you've got a great tangible example of government driving the initiative, the financial ministry and regulators supporting it, the mobile network operators of the telcos all involved in promoting the product, all of the banks offering the services to their unbanked, underserved customers, and most importantly, the retailers, the small mom and pop shops that are there to educate, build trust in the people. So you've got a collaborative effort of everybody in that ecosystem. And it's phenomenal what it's done at the very lowest common denominator, where people are now digitally included. They will not disperse any of the welfare payments in cash. The only way that you can receive it is through digital, and therefore they then encourage people to spend that digital money in the local mom and pop stores and the retail stores. I just wanted to give a practical example very quickly. Thank you.
All right, thank you very much, Brian. Okay, okay, so this question is for Mzondiwe. I'd like to ask you, do you think banks are failing to take advantage of the opportunity of banking the unbanked population? And, you know, with what you're doing with LendingScape as a digital lending platform, how can we overcome the challenges? Because, you know, why I noticed that many financial institutions do not even like giving loans to the unbanked population or to people at the bottom of the pyramid, because it just feels really peculiar to, you know, recover your funds back, because these people are very quick to, you know, disappear from where they stay, right? So can you, you know, share experience on how, you know, we can overcome challenges in lending to the unbanked population and, you know, reduce the rate of loan default? So those are like two-part questions.
Okay, thanks, Onyeka. I mean, it's a very, very good topic to discuss. First of all, I'd like to, you know, dispel the assertion that banks are failing, and just say that, you know, the challenges that banks are facing mainly lie in their inherent structures. So you find that banks were not built to sort of address the low-income population. If you take a look at the retail banking model, it sort of focuses on the comparatively higher, you know, value customers. So you have to then relook at the question and say, then what is the problem? So the problems are in twofold, and those are the barriers to entry into the unbanked population, which are both internal and external. Just to look at a few of them that are internal to the banks, would be the rigidity in their product set. So you find that the structure of their products, you know, including both pricing and supporting technology, you know, is more focused on dealing with fewer accounts and higher transactional volumes, or rather higher transactional value clients, compared to what you find in the unbanked population in the communities. So that from a product perspective is a challenge for the banking sector. But also there's an issue of the credit profiling. So you find that many of the unbanked clients, you know, have no traceable financial background. You find that, you know, even just looking at the, you know, the trail of documented wealth or possessions, or just indeed the income that they make is non-existent. So, you know, banks find it a challenge to sort of do a credit profile on a client that is supposed to extend the credit to. So that is a big challenge, you know, for them. And obviously, you know, beyond that, and, you know, you want to look at a very interesting piece that the owners of the banks especially have certain skepticism around investing their limited resources, you know, into the uncharted markets of the unbanked, especially where we're sitting in Zambia. You find that, I mean, to go into a population or a community that is of very low income, you know, would be sort of unprofitable to them. And it would be really difficult for owners to sort of venture into that market when they've got profitable avenues at their disposal. Even beyond that, if you, you know, if you say, fine, the board, the owners of the banks are willing to sort of move on, but you find that top management would be very, you know, unwilling to sort of venture into those unprofitable markets. I mean, for one reason, you know, bonus and reward systems in the banking sector for top management is based on short-term performance, which is very critical to them as individuals, and therefore that sort of works against the medium to long-term, you know, profitability per se. You obviously want to look at also the you know, the external challenges that would include things like connectivity. I mean, look, whereas certain countries like South Africa would be really highly connected, you know, on the network, you know, largely, you find that in Zambia there are certain parts of the country that are really not connected, or their connectivity is really you know, sort of unstable or very weak. So that obviously will counter, you know, how how banks can provide a very, very solid sort of banking applications at the expense of, ensuring that, they channel those resources to more profitable areas. Because obviously the argument would be, it's very, very challenging to roll out a branch network in places where, the return will be next to insignificant. You find that the communities, in terms of the social and economic status, is really, really, really unattractive from a household level of income. So despite, certain banks or financial institutions having the technology to sort of roll out certain products, it would be really, really difficult to sort of do a recoup of the investment within the, the appetite of the shareholders. The other thing is that whereas we've seen very, very good work from the MNOs and certain fintechs rolling out the payment systems, to the unbanked, sort of encouraging villagers and low-income individuals to sort of transact virtually, that has sort of not received the acceptance that you would like to sort of have in a certain community for you to have a solid, return in terms of doing that business. So you find that if banks come in and, and provide cash access points, it's sort of, the fear is that will trigger the cost of cash. You sort of get to have higher cost of cash transit, and the associated risks that come with that. So, then the question obviously begs to say, then what should they do? I would want to provide 3 solutions to the banks to sort of, come through as the alternative financial institutions or rather financial companies are doing. So you find that, banks need to start creating a history of the unbanked population, for their own medium to long-term survival, because for the medium term and the long term view, you find that these will become profitable avenues as we go forward. So you find that most of the population is not listed anywhere in the credit bureaus. Therefore, the investment in financial literacy would be the first step in setting up, getting them financially included. So obviously the low-hanging fruits will lie in sort of joining hands with development organizations and other MNOs and everybody that's doing some good financial literacy work, in the communities. So that's sort of very key in addressing those challenges. And the second bit I want to look at is banks need to also invest in very profitable ways of getting into those markets. I mentioned that alternative financial service companies are already trying to chart their ways into getting themselves sort of embedded into the profitable sectors in banked markets. But obviously, for banks to sort of win in that sort of a game, it would entail them relying on new technology, right? And then obviously that will ensure that the communities have access to products, without necessarily investing in expensive branch networks. But I mean, I'm worried of the fact that banks are not set up to handle microfinance product sets, because the type of products that the low-income communities would look for, the type of distribution model, the related technology, those are sort of accustomed to the sort of people that we're dealing with. I know when you open the remarks, you were like, those are people that are unreliable. You find today they live in this house, tomorrow they've shifted. So then how do you recover your loan? So it's really, really tricky. So obviously with their current infrastructure, they cannot offer the product flexibility for them to sort of operate in a much more nimble and dynamic way. So obviously there are sort of opportunities lie in setting up maybe a separate division, looking at new ways of working, using completely new teams, new technology, new infrastructure, creating an agility that's required in those markets. I think that's the sort of thinking that needs to come through for the banking sector. Secondly, and this I would recommend, is to say, they could invest or acquire existing alternative financial companies like LendingScape and the rest of them, to sort of have a quicker way of tapping into the unbanked markets. And that would sort of give them a foothold and compete with the MNOs and the Fintechs that are already, are charting their way forward into the unbanked sectors. Thank you, Onyeka.
Okay, thank you very much. I'll quickly head over to Edwin. This is your question. I know you're very passionate about gender financial inclusion. So please share your insight on why you think the rate of gender financial inclusion in developing countries is still slow, despite the tremendous potential that fintechs and digital financial service solutions have to offer. You're muted, Edwin.
There we go. Thank you very much, Onyeka, and similarly to the colleagues, panelists, 5 of whom have already raised the very important point around access. And I think one of the greatest things that are not often considered, and yet it is the backbone, a prerequisite, is that of access in developing countries where mobile data is frightfully expensive and broadband coverage is constrained. And when you look at the reality that we're talking about, you're looking at banking the unbanked, let's call it much broader than that, let's call it financial inclusion and the disparities that exist. It's very interesting to note that there are, whilst mobile and smartphone technology has seen a significant rollout and adoption, and we're talking about, if you look at GSMA statistics of recent, there's over 500 million people using smartphones. But the challenge, of course, is you're talking about the bottom of the pyramid, as was mentioned earlier. You're talking about individuals who don't have the wherewithal or the financial means to be able to incur the exorbitant costs for mobile data to educate themselves. And so when analyzing finance in the context of gender disparities, it's very important to distinguish between access to finance versus financial literacy. Whilst gender differences exist in both, the basis for this is notably different. See, financial literacy is a prerequisite in expanding financial system, yet gender inequality in financial literacy remains a major concern and a prerequisite for growth in the adoption rate of financial technologies. And a recent report published by the World Bank titled Financing Africa Through the Crisis and Beyond makes a series of recommendations to overcome those challenges. 3 key recommendations, one of which was to expand financial literacy. Similarly, on the 26th of April 2021, UNCTAD, which is the United Nations Conference on Trade and Development, published a similar article, and it showed that in many parts of the world, women have had less access to financial services than men for years. And the COVID pandemic has exacerbated this challenge. So I think one of the things that are often overlooked, as I mentioned, is that around the realities of the markets in which we're operating in. And if individuals, you could have the best technology in the world, but if individuals are not able to access that, are not able to be literate on those tool sets, well, then the disparity will only serve to grow. And so when one looks at what accounts for that gender gap in access to and the use of financial services, the gap often reflects social constraints resulting from things like domestic laws, regulations that exclude women from financial services. I mean, for example, in certain parts of the world, women are not allowed to become legal owners of productive resources such as land or properties. One of the speakers earlier made reference to the fact that not all applicants have the necessary collateral to lend and demand the assets that are registered in the borrower's name. And so in certain instances, women cannot have a bank account or business in their own name without husband's permission. And the way that financial services are set up can pose other impediments, for example, minimum balance requirements for opening an account. Now, all that I'm sharing here talks to literacy and the impediment that represents in the kind of adoption that we're needing. So with all the best technologies, it's naught unless people are literate on that and can genuinely access those instruments.
Okay, thank you very much. So I'll quickly go into the chat room and see if we have a few questions there. Please hold on. Let me see. Okay, There's a question here that says, and this question is for Brian. Are regulators in late adopter countries adopting mobile money and digital payments? Are regulators in late adopter countries for mobile and digital payments hindering financial inclusion by over-regulating the digital space and restricting competitiveness? Please, we have like a minute, 30 seconds to answer this question so that we can close in due time. Thank you very much.
Okay, very quickly, in all my global travels, and I've met with central banks all over the world, regulators all over the world, not one of them would say that the regulation is designed to hinder access, particularly at the bottom end of the pyramid. The harsh reality, unfortunately, is that it has. I'm delighted that most regulators today in the world are adopting a risk-based approach. They're saying to the banks, you tell us what risk profile you will adopt, how you're going to mitigate against that risk, and we will audit you and do our compliance audits against that risk-based profile. So I think there are great strides that are being made, but there's no question we need to be continually aware. As I say, regulators don't intentionally try and make it more difficult for access. But regulation follows innovation, not the other way around. So that's the way that the world works. I think getting the regulators on side, I've always found them very open to sit down and discuss issues and to look at ways around the issue. That's a very quick answer.
Onyeka, maybe just to add a very quick one there. In addition to supporting and following innovation, we've seen actually increasingly, especially on the subject of financial inclusion, regulators actually putting it in their own agenda. You know, I'm based in Tanzania at the moment, and there's a financial inclusion framework that the Bank of Tanzania drives and follows up. So there's quite a bit of progress from where we were. But what you find is that regulators regulate different industries, sometimes in stripes. So there's an insurance regulator, there's a communications regulator, etc. And how to bring it all together is, I think, where sometimes the challenge is.
All right, thank you very much. This question is for Martina. So how best can, well, it's almost like a piggybacking of this question. How best can regulators adapt to the changing digital landscape such that financial inclusion is accelerated fairly?
Yeah, I think it's actually a continuation to the question and answers given to the previous one. So as both Brian and Abdi said, there is no regulator that will try to restrict, in particular, such a noble cause as financial inclusion and as making people lives easier by providing them access to the financial services. Now, how can the regulation itself accelerate? I think it's not a crucial point in acceleration. It might be, the regulation might be a crucial restricting factor, but once that is eliminated, the acceleration will not happen just because of favorable regulation. Of course, it will happen partially because of that, but more importantly, when that forms as a base, a foundation for actually us, all the stakeholders in the ecosystem, to contribute their part in working, in doing what we all need to do to make financial inclusion happen. So yeah, one part, stakeholders will be FinTech and technology industry, who will drive different various digital services as such. The other key stakeholder will be banks or payment service banks in our case, that will provide that banking background and eventually also the last mile through the different networks of partners, of companies that have already the infrastructure in place. Obviously, that infrastructure part is the third key point. So there is a lot of different elements that all together combined will actually help accelerate the financial inclusion.
Thank you very much, Martina. And in addition to that, I would also, there was something that Brian said earlier talking about government-to-person payments. I also think that when many G2P payments are facilitated through digital, financial services, is one of the fastest ways actually to accelerate, financial inclusion. So there's a question here. I think this would be for Edwin. What strategy can be adopted to drive financial inclusion in rural areas of Africa, considering the challenges with technology and financial literacy level? 60 seconds, please.
Well, I think the first thing is not trying to do it yourself. To the points that Martina has raised, and others, Brian mentioned this earlier, is that one needs to find opportunities to collaborate in a far more real sense. And the experience we had with a bank in South Africa rolling out an education system for them on our data independent platform to 1 million individuals provided some fascinating insights and models that can be replicated in a number of countries, because the reality is that not everyone can afford or have access to the kind of content resources that are currently available online. The whole issue of online is actually a misnomer, because you've got to have connectivity to get online, and you've got to have serious broadband to be able to stream it. So I'd say the strategy would first and foremost be one seeking out competent partners with whom you can collaborate to achieve a great objective.
All right, thank you very much. Thank you, Brian. Thank you, Martina, Edwin, Mzondiwe, Anna, Abdi, and the organizers. Thank you very much for this amazing panel. A lot of recommendations and challenges and strategies have been discussed here, and the goal would be for us to go back to our various stations and continue to spread the gospel of financial inclusion for the unbanked and the underbanked. It was really great moderating this panel, and thank you very much.